We can start now, right?
It's 9:40.
Yeah,
Yes.
9:40. 9:40, that's what I'm thinking. Today we are going to do year-end adjustment. That one is page 41.
Oh, we are skipping the exercise 4.1, like the trial balance in the income statement and balance sheet.
Which one? Which one? 6-column worksheet.
Yeah. So we're going to skip that one?
6-column worksheet you finished last week, right?
No, I don't think we did. We finished up to 36.
Okay. We checked the YouTube about that, and I asked you to do it at home.
Okay.
And we can do it now if you want.
No, that's fine.
Yeah. And 4-2.
Okay.
4-2, if you want, you can do it. That one. If you understand 4-1, you understand 4-1, right?
Yeah.
How about other people? KG.
Hello. Sorry, Matilda, you were saying?
I didn't even get a chance to my juice.
Matilda, you were saying?
I'm asking 4-1. Do you want to do it 4-1 and 2 today or?
I didn't get a chance to take my juice.
Okay. Well, I've done it on my own. I don't know if you want us to do it again today, but you said we should try it, so I don't know if that's a challenge. I'm okay with it.
I'm going to
challenge you would like us to talk about. I think it's just pretty straightforward. There was nothing to adjust, so
I'm going to show the answers. Then we can go to next one, right?
Yes, please.
Okay, this is the answer, KG. 4-1. Uh, 4-1, I ask you to do it at home. This is the answer.
Matilda, we cannot see the answer right now. You stopped sharing.
No, it's sharing mode.
No, I can see.
Okay, I got the same thing, Matilda.
Sorry, my mistake.
This is just one word.
Okay, I got the same thing, Matilda. I don't know if anybody has an issue, but me, I'm fine. Yeah.
Thank you. Next one. Next one also, did you do the next one? 4-2?
Yeah, it's the same thing as the other one, right?
No, 4-2, there are some errors.
Yeah, but like this idea is the same, right? It's just
Same. Yeah, same. Same, but we have to find out the errors, and these are the errors. The answer is this. This is actually loss, not the profit. It's loss. Loss is in the opposite side. Now we can go to page 41. Anybody want to read it? Year-end adjustments.
If nobody wants, I can read.
Yeah.
You have to leave today at 10 o'clock, so yeah, somebody else should read it.
Okay. Adjusting entries. Adjusting entries are made in your accounting journals at the end of an accounting period after a trial balance is prepared. The purpose of adjusting entries is to adjust revenues and expenses to the accounting period in which they occurred. After the entries are made in the accounting journals, they are posted to the general ledger in the same way as any other accounting journal entry. If you are using an accrual accounting system, that means that the money didn't not necessarily change hands at that time. The purpose of adjusting entries is to show when the money changed hands and to convert your real-time entries to entries that reflect your accrual accounting system.
You understand that part, right? Any questions?
Could you remind me, please, what is accrual accounting?
Accrual accounting means in accrual accounting system, you have accounts payable and account receivable. That means even though you are not getting money, you're showing your transactions. That is accrual. The other one is as soon as you get the money, you are doing the transaction. That is, that one is cash, not the accrual, cash-related transactions. Accrual transaction is important. That one is for matching principle. According to the matching principle, all the companies, they are doing accrual accounting. Yeah.
Okay, right. Thank you. 5 types of adjusting entries. First, matching principle. All expenses incurred in earning revenue of a particular period are to be charged against that particular period's revenue.
Now, this is the matching. This is the accrual accounting.
Accurate revenues. If you perform a service for a customer in one month but don't bill the customer until the next month, you would make an adjusting entry showing the revenue in the months you performed the service. You would debit accounts receivable and credit service revenue. Accrued expenses. A good example of accrued expenses is wage paid to employees. When a business firm owes wages to employees at the end of an accounting period, they make an adjusting journal entry by debiting wage expense and crediting wage payable.
That is, that is, you understand that, yeah?
Yes.
Because normally it's happening weekly payroll and bi-weekly payroll. That one is happening. If you see the screen, we have bi-weekly payroll. The first payroll was in July 13th. The second one is July 27th. The third one is July 10th. When you see the July 10th, there are 2 days, no, August 10th. There are 2 days in July, 8 days in August. But you are doing in August. These 2 days, you have to calculate how much is for 2 days, and you have to do the adjusting entries for July. After you finish your payroll in August, then you have to reverse these 2 entries, these 2 days from August. You understand what I'm talking about?
Yes.
Yeah, this is the accrued expenses, especially wages, weekly payroll and bi-weekly payroll. We have to do this adjustment at the end of the month. Yeah, monthly payroll and semi-monthly, that one is going to cover according to months. But this one you have accrued wages. You have to calculate the end of the month and do it. Yeah, that is the one. You have another expenses also, accrued expenses. Insurance also accrued expenses. No, that one is prepaid. Especially wages, it's a good example. Next one.
Unearned revenues. Unearned revenues refer to payments for goods to be delivered in the future or services to be performed, like insurance.
No, this is not. This is not the unearned. Insurance is not the unearned revenue. Insurance is the prepayment. Unearned revenue is normally that one is happening in hotels and fly or air flight.
Oh, booking. Mm-hmm.
Yeah, you are paying advance, right? The hotel also you are paying advance. For the hotel, that one is unearned revenue until you use the hotel.
Mm-hmm.
That is the, and flight also you are paying advance. That company, whenever they get the advance from you, they are putting in unearned revenue until you use.
Right.
Yeah, that is the unearned revenue.
Example, a client purchased a package of 20-person training sessions for $2,000 or $100 per session. She pays for them in advance. The personal trainers enters $2,000 as a debit to cash and $2,000 as a credit to unearned revenue.
Yeah, because the course is going to be longer than a month, right?
Yes.
Then they are recording unearned revenue every month. They are transferring for revenue account.
Prepaid expenses. Prepaid expenses are a very descriptive title. Prepaid expenses are assets that are paid for and gradually get used up during the accounting period. A common example of prepaid expenses is office supplies. A company buys and pays for office supplies. Gradually, during the accounting period, the office supplies are used up. As they are used up, they become an expense. During the months when the office supplies are used, an adjusting entry is made to debit office supply expense and credit prepaid office supplies.
Mm-hmm.
Mm-hmm.
Yeah, normally they are buying 50 boxes, papers, and that kind of things, the company. But they are using only 5 boxes per month, right? According to that, we have to transfer. That is the prepaid expenses. Insurance also a good example, because insurance also we're supposed to pay for 12 months at the beginning. Then that one is the prepaid insurance. Every month we have to transfer how much expired from that year.
Mm-hmm. Depreciation. Depreciation is a process of allocating the cost of an asset, such as building or a piece of equipment, over the serviceable or economic life of the asset. Adjusting entries are a little different for depreciation. Business owners have to take accumulated depreciation into account. Accumulated depreciation is just what it says, the accumulated depreciation of a company's assets over the life of the asset. The accumulated depreciation account of the balance sheet is called a contra-asset account, and it is used to record depreciation expense. Increases are recorded as credits in contra-asset accounts. When an asset is purchased, it depreciates by some amount every month. For that month, an adjusting entry is made to debit depreciation expense, equipment and credit accumulated depreciation by the same amount.
This you understand, right?
Yes. Which way of depreciation is the most popular? Equal sum every year, or?
Yeah, depends. Big companies, they are using a different way according to units. No, not big companies, the manufacturing companies. The unit method, normally everybody is using the standard method, divided by how many years. According to that, they are depreciating. The factories and machineries, they are using in a different way. You are going to learn that one. There are 3 or 4, 5 kind of ways.
Adjustment for doubtful accounts of customers. Most businesses buy and sell on credit. Before setting up an account for the customer, a credit check was done. However, there are always some customers who do not pay their bills. The customer accounts that are not likely to be paid are called doubtful accounts. It's doubtful the balance owing will be collected. Doubtful accounts are identified by the length of time the debt is left unpaid. It should be recorded on the balance sheet because it should be deducted from the accounts receivable in order to give a true picture of the value of the receivables. And any loss from uncollectible debts represents an expense and must be recorded as an expense in the same period the sales to which they are related were made. The two generally accepted methods of accounting for receivables that are seen to be uncollectible are the allowance method and the direct write-off method. The allowance method. Adjust an entry for an estimated value of doubtful accounts. First, the percentage method. Second, the aging method. The percentage method. A. Percentage of total accounts receivable based on past experience. A corporate business notes that each year for the past 10 years, the average value of uncollectible accounts has been 3% of total receivable owed at the end of the fiscal period. Total value of accounts receivable 17,890, estimated uncollectible at 3%, 536.7.
This you understand, right? Sometimes in the uncollectible account, sometimes you will receive, sometimes you are not going to receive that. In that case, you have to show as bad debts. If you don't receive it, after that, you have to show as bad debts.
Bad debts.
Mm-hmm. So we're not discussing here the aging method.
Aging method according to 30 days, 60 days, and 90 days. If it is past 90 days, then they are going to calculate according to that, and they are going to show as a doubtful account.
Ah, I see.
Yeah. 30 days is the normal due date. If it is past more than 90 days, so more than 100 days, that one is going to be undoubtful account. Doubtful.
Wow.
Yeah, they are the doubtful account. That is the aging method.
I said wow because it's always about negotiation between customer and the company.
Yeah.
90 days might be not enough.
Actually, normally the company's negotiation is 30 days, right? Sometimes 45 days, mostly 30 days. If it is 90 days, they have to send for the collection agency. That is the way they are doing. They are sending the statement and the warning and everything. After that, if they don't receive after 90 days, then they are going to send it to collection agencies. Even if from collection agencies also, if they couldn't able to collect it, that one is the doubtful account or bad debts.
Prepare the adjusted trial balance. After you make your adjusted entries, you post your adjusted entries to your general ledger account. Prepare the adjusted trial balance. The process is just like preparing the trial balance, except the adjusted entries are used. In adjusting prepared expenses, first determine the value of the expired portion of the expense. Adjust the value of the expired portion out of the current asset account and into an appropriate expense account. The balance remaining in the prepared expense current assets account is the value portion of the asset that has not expired and properly belongs to the next fiscal period.
Next fiscal period, yeah.
Record the adjustment on the worksheet.
After you finish adjusting entries, the worksheet you already did for 6-column worksheet, the same thing you are going to have 8-column worksheet. That is the unadjusted trial balance, then adjusting entries, then adjusted trial balance. After that, they are going to prepare the income statement and the balance sheet. Auditors, they are doing like that way. They are going to have unadjusted trial balance, then they are going to have adjusting entries. After that, adjusted trial balance. From that, they are preparing the financial statements. Auditors, when they come to audit, they are using this. There are some adjusting entries examples: depreciation, allowance for doubtful, accrued revenue. Then you can check by yourself. And now we can do the exercise 4-3, page 45. We can do the exercise now, right? Any questions about adjusting entries? When you are doing the exercise also, you will understand.
Okay.
Exercise 4-3, you have trial balance, unadjusted trial balance. Then you have some data for the adjustments. That one you are going to do it now. Check your trial balance. You have prepaid insurance, supplies, and also fixed assets, cottages, furniture, and you have unearned revenue. Those kind of things you are going to do the adjusting entries. Do you want to read it, Kate?
Yes. Starting with other data.
Highland.
The Highland Cove Resort has fiscal year end of December 31st. The company's trial balance before adjustment is as follows.
Okay. Trial balance, you don't have to read it. They can see. The data, you can read it.
Okay. 1 year insurance policy was purchased on May 31st, 2018. And now we have to, as this is prepaid expenses, we have to divide the sum to 12, and then use only June, July, and further months, which is 7 months.
May to December, not May, June to December.
June to December.
Yeah, June, July, August, September, October, November, December. Yes, 7 months. Good. You have to calculate first. Are you going to do it at the same time? You have the worksheet, right? I sent the worksheet already for the journal.
Yes.
Yes, we do.
Yeah. You can open that and we can do together. That one is easier. I think you understand this very much. You are all accountants, right?
Yes. No. Well, if it would be a real a job, I would say yes. But since it's learning, it's better to ask twice.
Yeah. Okay. Yeah. But there is, I think one lady is missing. She's always asking questions.
Mafisa.
No, not that lady.
Tugba is missing as well. I don't know where she.
Is it Bina?
The Japanese, I think. Japanese.
Nobody is.
Bina?
I don't know the name.
Yeah.
She likes to do the exercise always. Yeah.
All right, let me just send it.
Okay, the first one is 1 year insurance. What kind of accounts are affected by this?
Prepared expenses
And
prepared insurance.
Insurance expense and prepaid insurance. Yeah. Insurance expense is debit, prepaid insurance is credit. We are going to divide it by 12 and multiply by 7. That is the answer.
Yeah, this is 3,710.
Yeah. Insurance expense is debit, prepaid insurance is credit.
Okay. Number 2. Account shows $690 of supplies on hand.
Not account. A physical count. That is, I think the word is missing. Physical count.
Sorry, Matilda, which count?
Physically, when they are counting, Your
Oh,
physical count shows, yeah.
Okay.
The physical is missing there, yeah.
Physical account shows 690 of supplies on hand on December 31st. Okay.
You have supplies in your trial balance, right? You purchased for 3,495. You recorded immediately supplies debit and cash credit. At the end of the year, when you count in the storage, physically when you are counting, you show only 690 value of the supplies in the storage. According to the storage record and your book is not balancing, then you have to do the adjustment, right?
Mm-hmm.
How you are going to?
I see. Expenses, supply expenses is the rest, which is 3,495 minus 600.
It's 90, yeah. That is the expenses, a debit, yeah. Credit?
Credit is
credit is supplies, right? You are going to decrease from supplies and increase your expenses.
yes. And supplies prepared 690 and 690.
690 is going to use for the next year, but you have to show supplies expenses 3495 minus 690. The same amount you are going to decrease from the supplies. Credit, yeah.
Right. 2,805.
Mm-hmm.
The cottage has an estimated useful life of 50 years.
Mm-hmm.
Okay, this is about depreciation.
Mm-hmm.
Cottage $145.
145,000. You are going to calculate it. Yeah. You are going to divide it by 50.
Yes, and
that is your depreciation.
Should we calculate length as well? No, because length here is...
This is end of the year you are doing, right? Then you are going to divide it by 50. Actually, according to the cottage, you have some accumulated depreciation also in your trial balance. That is the previous history. This year you are going to calculate 145 divided by 50. That is your depreciation. Depreciation or amortization.
How do we know that the cottage price is 145,000? Maybe it's just the rest of the price that we have.
No, we have to calculate for the original price. That is the standard calculation. That is another method. 145 divided by accumulated depreciation. From that you are going to calculate. That's a different method. This one is the standard method. You are going to learn depreciation exercise. After that, then you will learn three kind of depreciation. That one is
okay.
Double declined unit method, the standard method, something like that. Yeah.
Then we credit cottage and debit.
Not cottage. Accumulated amortization, because cottage price in the book we have to show the original price always. The purchase price, that one has to be in the book all the time. Accumulated depreciation is going to be increased every year. The book value in the balance sheet, you can see the book value. There are two columns. Inner column is going to show original price and the depreciation. The outer column is going to show book value. Original price minus depreciation, that is your book value. After 50 years, your book value is going to be 0, right?
Right.
Yeah.
Okay, furniture. The furniture had an estimated useful life of 10 years. Okay, let's divide 28,600 to 10.
Divided by 10, yeah.
By 10?
Yeah. That
And, and we credit accumulated amortization furniture.
Yeah.
And we debit. Oh, we debited.
Yeah.
And we credit
accumulated amortization furniture is credited. Yeah. You are going to have separate account for accumulated amortization, because for the book value you have to show. If you want to calculate your book value, you have to show it separately. Yeah. You can see the trial balance. They have separate accumulated depreciation, right? Furniture they have, cottage they have separate. Yeah.
Yes, 11,000. Okay. The customers must pay 100 deposit if they want to book a cottage during peak times. An analysis of this booking indicates that 355 deposits were received, and only 45 of the deposits have not been earned by December 31st.
If you see the unearned revenue, 355 people, they paid according to $100. In the trial balance, you can see $35,500 in unearned revenue, right?
Yes.
That unearned revenue, part of the people they already used, some of the people they didn't use. In that case,
we have to minus 4,500 because they never use it with deposit. Yeah. And this is not unearned revenue, but just revenue already, right?
Yeah. For 4,500, that one is not earned. That is going to be carry over to next year as unearned revenue, 4,500. The rest you are going to transfer to revenue account. The same way they purchase unearned revenue. This is the first entry, 35,500, and credit bank, debit bank. Now you are going to transfer part of it going to revenue account and unearned revenue credit debit. This 4,500, this one is going to be next year. The 45 people they are going to use next year, or they have to give back that money, or whatever they are going to do it, but we have to show as unearned revenue in the book. In that case,
so Matilda, could you please repeat what we are doing with the rest of the sum? 35,000 minus
4,500. That one is you are going to show as revenue, because this one is in the liability account. Unearned revenue in the trial balance, it is in the liability account, but that one is your revenue, because part of the people they used, still we have in the unearned revenue in the liability account. Now we have to transfer to revenue account. How many people they used, those amount has to go to revenue account. Yeah, you have to show as revenue. This amount, $31,000, that one we have to show as revenue because they used our cottage, right? Then this one we have to show as revenue account. Revenue account is credit, that one is going here, revenue credit, and unearned revenue is going to be debit, that one is going to be decreased from this. Your unearned revenue is only $4,500 in the trial balance after you adjust. Your trial balance is showing only $4,500. The rest you are transferring to revenue account. Are you okay?
Yes, yes. Thank you.
You're welcome. This is
Okay.
happening in the cottage, hotels, the air tickets. There it's happening like this.
Mhm.
Always getting the advance and putting the unearned revenue. Every time when the people use, they immediately transfer, but this company is showing like this way to learn how to do that. But in the real life, every month they are transferring to revenue account. According to the matching principle, they're supposed to transfer.
Number 6, the mortgage interest rate is 6.5% per year. Interest has been paid to November 30th, 2018. We have mortgage payable, but in the sum, 60,000, we have mortgage interest.
We have to calculate interest only for 1 month because they paid up to November. They haven't paid for December, right? Then you have to calculate interest for December, and that one is going to be interest expense and interest payable in the liability account. You are going to pay in January, right? Yeah, that one is showing in the interest payable account. First, you have to calculate how much is the interest for December.
30, no. $325. I just divided.
Multiply by percentage and divided by 12. Yeah. Yes. That one 6.5 for the year. Then you have to 6.5%. That one is for the year, right? Then you have to calculate according to that and divided by 12. That is the interest expense. The credit is interest payable. That one is going to be in your book.
Interest payable. Okay, number 7. The salaries accrued to the end of December 31st were 2,800. And we have salaries expenses.
Yeah, salary expenses.
153,000. Why? Did they pay 153 instead of?
Actually, this one is salaries expenses, right? Salaries expenses, they give the amount. The same amount they haven't paid. Same as like the bi-weekly payroll, I show that. According to that, they're supposed to pay 2,800 in that month, December, but it's going to be in January. In that case, we have to show salaries expenses and salaries payable at 2,800.
Oh, I see. So we're not touching 153. We just take 2,800 because it will be paid in January.
1,053,000. That one is the history of the salary, the whole year. This amount from the December part of the days they haven't paid. That is, they are going to pay in January. Actually, this is happening in bi-weekly and weekly payroll. I show that bi-weekly calendar. According to that, they are calculating some days from December. They are going to pay in January. In that case, we have to show as salaries expenses and salaries payable.
There you go.
Are you okay?
Yes, moving further. Number 8, the December utility bill, maybe bill,
Bill.
of 1,560 is unrecorded and unpaid.
Mm-hmm.
Okay, utility bill,
Mm-hmm.
unrecorded and unpaid. Well, we still have to add it to expenses and to utility payable.
Yeah, utility payable. Utilities normally every month we are paying. We are going to have vendor's name in our accounts payable book. You can show as accounts payable. Utilities expenses debit, accounts payable credit. Because utilities monthly payment, we have in the vendors list as utilities company name, right? In
Mm-hmm.
that case, yeah, utilities expense and accounts payable.
Number 9. On December 1st, a local business contracted with a Highland Cove Resort to rent one of their cottages for 6 months starting January 1st, and the rate of 1,000 per month. An advance payment equal to 2 months of rent paid on December 15th.
Mhm.
Okay, it's $3,000 unearned revenue, rent revenue.
Mm-hmm. Rent revenue? Not.
Not revenue. Okay.
Mm-hmm.
Yes, rent revenue, but unpaid. We have to unearned rent revenue.
Unearned rent revenue, yes. And bank is debit.
Debit.
Yeah, because they haven't recorded, but they receive the money. In that case, $3,000 bank is going to be increased by $3,000, and unearned revenue is also increased by $3,000.
Instruction journalize the annual adjusting entries at December 31st. We did adjust. Oh, yes. The next exercise.
Oh, next exercise. Before next exercise, after you finish this journal, you are going to do it in 8-column worksheet. I think you have a 8-column worksheet in your screen, in your worksheet. That one is going to be. This is the 8-column worksheet. You have it.
I'm searching for it.
Yeah.
On the worksheet.
Yeah, in the worksheet you have, I think, right? You don't have it?
If you could name the cell number, I cannot see it in the worksheet exercise 4-3.
Worksheet 4-3.
Can you name the cell?
So?
Yes, the for example
No.
J10 or
No. Go to the bottom. You can see the tab, right? Exercise 4-3.
mm-hmm.
Yeah, this is the tab you can see. See this one? Not the cell address. Go back to the bottom.
Okay, I see worksheet. It says W sheet. Okay, I found it. Thank you so much.
Worksheet 4-3.
Yes.
This one has unadjusted trial balance. I think you have the trial balance, right? Oh, you have
Yeah. Yes, it's
You
all
have-
written.
Okay. Then you have another 2 columns that is for adjustments. Then after that, you are going to calculate adjusted trial balance. From the adjusted trial balance, you are going to prepare income statement and the balance sheet. Now what you are going to do is you are going to transfer this journal to adjusted trial balance. No, adjustments. When you are transferring the adjustments, whatever you have in debit, you are going to put in the debit side, and also the number also you are going to put in the middle, because I'm going to show the first one. The first one is insurance expense and insurance, prepaid insurance, right? Insurance expense is going to be debit 3,710, and also the number. This is not the date. This is the date as number, because after that, if it is not balanced, we have to go back and check. That one is the cross reference. We have to put the number also. Insurance expense 3,710 and prepaid insurance credit 3,010, and the number is 1. In that case, you are going to record here insurance expense. That one is going to be debit. Debit 3,710 and also the number, and then go to prepaid insurance. That one is credit. You are going to put the number. The same way you are going to record the adjustments. Then after that, we can do this column now, right? The first one, the first transaction is affected by insurance expense debit and prepaid insurance credit, and also the number is 1. Then go to the worksheet, and you are going to record prepaid insurance expense debit this amount, and also the number is 1. And at the same time, prepaid insurance credit that amount, and the number is 1.
Yes.
We are going to use J27, that is expense.
Supplies expense.
Next one is
Credit supplies and the transaction number 2.
yeah,
And debit
supplies expense.
supplies expense.
Yeah, and supplies, that one is number 2. And supplies expense.
Okay.
One
Transaction number 3 is credit. Yes, accumulated amortization cottage.
Yeah, and debit is amortization expense. Go back to amortization cottage expense debit, and accumulated amortization cottage is credit.
Number 4.
Amortization expense and amortization furniture, accumulated amortization furniture, accumulated amortization furniture, and accumulated amortization expense. And then revenue 31,000, and revenue 31,000.
We debit unearned revenue
Yeah.
for 4,500.
No, 31,000.
31,000?
Yeah, because 31,000 we earned, 4,500 we are going to leave it. 31,000 we earned. See, this is the transaction.
All right, right.
31,000. Where is it? 31,000 we earned. That is going to revenue account, decreasing from unearned revenue 31,000. 4,500 you will see the answer after you adjust.
Mm-hmm.
Next one is interest expense and interest payable. Same thing, salaries expense and salaries payable.
Oh, we missed the mortgage percent.
Oh,
Number 6.
interest expense,
Mm-hmm.
mortgage percentage. I missed that one. No, that is the interest. Oh, not the mortgage. For mortgage, we are paying interest, right? It's not amount to mortgage. It is interest. Next one, salaries, utility. Utilities expense. Much. And utility accounts payable. Next one. Next one is the bank and unearned revenue. Bank is increasing by that amount, and unearned revenue is increasing. After we record all the adjustments, you have to total in the bottom. And if it is not balanced, you have to go back and check. That's why we are putting this number. Sometimes the manual accounting, sometimes you will have a chance to make mistakes, but in the computerized accounting, if whatever you do, everything will be go automatically. Now it is fine. Now we are going to calculate our adjusted trial balance. Because in the unadjusted trial balance, we have debit balances, credit balances. Adjusted trial balance also we have debit balances, credit balances. According to bank, both are debit balance, then we are going to add. If it is debit and a credit, we are going to minus. That you understand, right? How to calculate.
Mm-hmm.
Bank is debit. This one also debit. Then you have to total both and put it here. And the second line, prepaid insurance, one is debit and one is credit. That means we have to minus from debit balance to credit balance. The debit balance is highest, then it's going to be in the debit side. This is the amount is carry over for next year. Because this one you used already, this much supplies you have in your storage, you are going to use next year. Now your storage accounts records and your books also now balanced. The same way, no, that is the insurance. Insurance is according to the book. This is the supplies is going to be, this is the total supplies in your debit and here also credit. This is highest, this is your balance. This is the amount you are going to use it next year. This is the amount they give in the data, right? How much they have in your storage. And land same, nothing happened for land. And accumulated depreciation, you have credit balance and also in the adjusted also you have credit. If it is credit both, you are going to add together and put it there. This one also same cottages. And now you are going to add together and put it there. And the next one, furniture, nothing happened, same. Accumulated depreciation is going to, both are credit, add together. You are doing, right?
Mm-hmm.
Okay. Everybody is doing. I hope everybody is doing. And next one is accounts payable. Both are credit. You have to add together. And interest payable, you have only one in the middle. You are going to bring the same amount. The same way salaries payable. And unearned revenue, you have debit balance and the credit balance. You are going to minus the debit plus the credit. Your total balance is credit balance. You have debit balance and you have to minus. And the rest you are going to add together. The mortgage payable, nothing happened. Capital, nothing happened. Drawings, nothing. And the revenue, you have both credit balances, you have to add together. And the interest expense, you have both debit balances, salaries expense, debit balances. And next one is interest expense, debit balances. Utilities expense, debit balance. Repair expense, nothing. And this one is only adjusted debit balance. And amortization expense, debit. This is our after adjustment. This is the actual trial balance, adjusted trial balance. From this trial balance at the end of the year, we are going to calculate our income statement and the balance sheet. You understand now, right?
May I ask you, where should we put utilities payable? Utilities.
Accounts payable.
Yes, but we have only interest payable and salaries payable here.
You have accounts payable. Let's see.
Oh, just in general. Okay.
Because utilities you are paying every month, you have the vendors list, right, in the accounts payable.
Mm-hmm.
That will be put in the accounts payable, yeah. Otherwise, you can create in utility payable separately, but it doesn't matter. We have accounts payable too, right?
Mm-hmm.
And then we are going to calculate the total. And this is the way auditors they are doing. Auditors, they are doing in Excel. They record everything in the Excel and check the adjustments and then calculate the adjusting trial balance. From that, they are creating the income statement and the balance sheet. From that, you are going to, after you finish, you are going to calculate, you are going to prepare the income statement and the balance sheet. You can copy and paste from this income statement and balance sheet. After you, after you finish, we can do 404 after you finish.
Okay.
Let me. Hello? I am in the class, Mary. May I call you later? Yeah, at home. Yeah, at home. At home, we are doing by Zoom. I will call you later, okay? I was talking about you yesterday. Okay? I was talking I was talking about you with Shalini yesterday about the one that you are using, what is that? The liquid you are using for sinus?
Oh, yeah, but I have an idea. I'll see you later. I think maybe more advice that I have now.
Okay,
Really?
okay. Thank you so much. Then I will call you later, okay? Okay, bye.
Yeah.
Uh, can we do the next one after you finish, huh?
Sorry, Matilda, can I see the worksheet again from the beginning?
Okay, okay. Okay,
Thank you.
yeah.
The top part. Okay.
Death and Legacy. On April 4th, 1968, King was shot and killed. He was in Memphis, Tennessee. King saw a need for change. He made a difference, and he found peaceful ways to do it. He is still remembered as a great leader. Jorge Bergoglio. Jorge Bergoglio.
Have you finished answering this one, the one you did?
17.
Yes.
What did she say she do?
She said we should write when he was born and when he died, and I did it.
So you're not supposed to write all these ones.
I don't know what to do then.
Did she tell you to do or just the date born and died? That's the only thing she
The
told you.
only thing she said about was that when he was born and when he was dead. Those were the only things.
Then who is the person? Did you write the name now?
Oh.
Oh, sugar.
I wish somebody could explain me about income statement.
Income,
Does it affect the
income,
balance sheet?
yeah, income statement, yes. This is the income statement. This one is starting from revenue to expenses. We are transferred to middle column income statement, right? From the income statement, we are going to calculate profit or loss. This is the revenue, this is the expenses. Do you want to see that last time you see that the YouTube, right? Remember? From this, we are going to calculate our profit or loss. If it is profit, that one is going to be in the debit side because we are going to transfer to credit side in the balance sheet. The balance sheet is increased by profit. If it is loss, that one is going to be in the credit side, transferred to balance sheet in the debit side to decrease the capital. According to this, our income is income statement showing profit, right? This is the total. We calculate the total. From that, the difference between those two is higher. Our revenue is higher than the profit we put in the debit side. Then after that, we have to total both this and this. This should be equal. Then this is the profit we are transferring in the balance sheet in the credit side because capital is increased by profit, right? Then this is the balance from the debit side. This is the total from the credit side. Both has to be equal. If you want, I can show that YouTube again.
Well, for some reason I don't remember it. Maybe I just missed it because last time I don't know why I don't remember this.
Okay, yeah, I'm going to show it. Anyways. They explain very well in that.
Today we're going to start looking at these. 6-column worksheet and understand a little bit more about why we use the 6-column worksheet and what items are included in the 6-item worksheet. Or I'm sorry, the 6-column worksheet. So what you see here is an example of a 6-column worksheet, or at least the start of it, for Roadrunner Delivery Company, which is the company that we've been using as an example throughout the first quarter of this course. So you'll notice that the trial balance has been added into this worksheet already. But what I first want to point out to you are the 5 sections of this 6-column worksheet. So what we have first are the 3 columns up, or the 3 rows up top. We have, this is called our 3-row heading. It includes the name of our company, what we're looking at, which is our worksheet, and the accounting period that we're looking at. So for example, this accounting period is for the month ending October 31st, 2013. So this is kind of like part 1 of our section 1 of our 6-column worksheet. Section 2 includes our account numbers and account names. And you'll notice that these are in order: assets, then liabilities, then owner's equity, we've got our revenue, then our expenses. And each of the accounts that are listed in our chart of accounts are included on this trial balance, or on this section of our worksheet. So this is section 2, the account number and account name. Section 3 is our trial balance, and it includes a debit column and a credit column. Section 4 is our income statement column, which includes a debit and a credit column. And also then the last section is the balance sheet section, which includes a debit and a credit column as well. The whole purpose of this worksheet is to start to compile information that is going to be included in the financial statements that we're going to prepare later. So typically, the work that you have been doing, the tedious stuff that some of you haven't really enjoyed, that's usually done by a company's bookkeeper. Now, the financial statements are done by a certified public accountant, okay? So this gets a little bit more high level. This stuff is written for the investors as opposed to the managers within the company. So let's get started here. As you notice, we've got our trial balance filled in. We have done the trial balance a couple of different times. You know how to do the trial balance. Any asset account or anything that has a normal debit balance, we put our ending balance here on the debit side. Anything that has a normal credit balance, we put our ending ledger balances in the credit column. And the whole goal of our trial balance is that these 2 columns, both the debit column and the credit column, are going to be equal. And if they're not, we have problems, right? And we have to go solve those problems. Now, the 2 new columns that you're going to see, or the 2 new sections, are the income statement and the balance sheet. Now, there are certain items that are included on the balance sheet and certain items that are included on the income statement. What's included, I'm going to skip over to the balance sheet first. The items that are going to be included on your balance sheet are going to be your assets, your liabilities, and your owner's equity. So we have everything from the 100s to the 200s to the 300s, okay? And basically, all we're going to do is we're going to copy the debit and the credit column from that section, and we're going to paste it over on the balance sheet, okay? So we are only going to look at our permanent accounts, our asset accounts, our liability accounts, and our owner's equity, okay? And our owner's equity does include withdrawals. Now, for our income statement, we are going to take our temporary accounts, or our revenue, and our expenses. So we are going to take the 400 and the 500 numbered accounts, and we are literally going to copy and paste them over in our income statement, okay? Now, we need to figure out what the totals are for these rows, right? Now, do you think they're going to come out equal? Well, let's find out, okay? So if we add up, and I'm just going to use a formula, okay? And I'm going to use this same formula that I used over here, the sum of H7 to H22. And I'm going to use something similar over here. Now I am in column J. So I'm going to do equal sign, sum, open parentheses, and I'm going to add these 4 together, okay? That way, if any of these change, if I notice that there is an error, it will automatically change this number. So right now, I have $1,500 worth of expenses. These are my 4 expense accounts, and I have $1,500 worth of expenses. Okay, I am going to take this amount up here, this $2,650, and I'm going to bring it down here. Okay, now these do not equal each other, but I'm not overly concerned about that just yet. I'm going to do the same over here. I'm going to do equal sign sum, and I'm going to grab everything that shows up in this column. Okay, and I come out to $38,275. Okay, and I'm going to take the same formula, and I'm going to apply it here. Formulas are so easy because it allows you to not really think about a whole lot here. Okay, now we notice that our income statement and our balance sheet, and I'm just going to add a line down here at the bottom. You'll notice that our income statement and our balance sheet, the debits and the credits do not equal, but that's not to be too concerning just yet. So now what we want to do, we're going to focus on our income statement section, and we're going to try and find out, do we have a net income or do we have a net loss? Okay. Now, net income basically tells us the amount of revenue that we've received after all of our expenses are subtracted, or after all of our expenses are paid. So what we're going to do is we are going to skip a line down here. After our utilities expense, let's skip a line and let's put in net income, okay? And we're going to be looking at what our net income is for this accounting period, which is the month ending October 31st, okay? We are going to enter our net income into the debit side, or the debit column of that income statement section, okay? So in order to find what net income is, we're going to take our revenue minus our expenses, okay? So I'm going to do a simple formula in here. I love formulas, okay? I'm going to do the equal sign, and I'm going to click on my revenue minus my expenses, okay? So what I came up with is that I have $1,150 worth of net income, right? My revenue is greater than my expenses, okay? If my expenses were greater than my revenue, I would have a net loss, and my net loss would be in the credit column of my income statement. But since I made money, I have net income, we're going to put that in the debit section, okay? Now, we are going to take this same amount, and we are going to put it in the credit column of our balance sheet. And I'm going to tell you why in just a second. But I'm going to use a formula, equal sign, just click on the cell and hit enter, okay? So you've noticed I've got net income that's highlighted right here in the debit section of my income statement. And I've also got net income over here in my credit side of my balance sheet. Now, why do I put it on my balance sheet? Let me tell you why. I'm going to click over here to my second tab, and I'm going to look at the effects of net income or net loss on capital. Basically, we said that net income is revenue minus our expenses, okay? Revenue and expenses are typically temporary accounts, right? During the month, we consider them to be temporary. Well, at the end of an accounting cycle, we transfer those over to our capital, okay? So our net income is increasing our claim in the business. So we are increasing our capital. Since our revenue is greater than our expenses and we have net income, it's increasing our capital. Now, if we would have had a net loss, which would have meant that our revenue is less than our expenses, it would decrease our capital, okay? Since we know that our capital is increased on the credit side, that is why we enter our net income on the credit side, because our owner's equity or our capital account is increasing because we have more income, okay? Now, all we need to do now is we need to double check our accuracy, and we need to total up our columns, okay? So we're going to add another line below these columns. I'm going to do this up at the top here. And basically, all I'm going to do is I'm going to total my columns. So here again, I'm going to do equal sign sum. I'm going to grab everything below the line ahead, and I've got 2650. And what do you notice? That's our total up here in the credit column. So again, I'm just going to bring that number down, and we've got items that equal each other, right? Now let's try it over here on the balance sheet. If we take the sum of these two columns here, we've got 26,550, which does not equal what we have here. So we've got to go back and we've got to figure out, what's our problem here, okay? And it looks like, if you look at this amount here, it looks like all I did was I took the sum of cell P15, which is this cell here, okay? So I want to take this formula right here and I want to correct it. I want to do the sum of all three of these columns together, okay? So all I did was I changed that formula, and what do you know? It comes out to 38,275 down here because I had my formula and I changed this cell plus this cell, it automatically changed for me, okay? So now what I'm going to do is just bring down this number here, and we've got two columns, our debit and our credit column, that now equal each other, okay? So what we have done is we have used our trial balance, which we had already had before. Instead of having it on its own spreadsheet or its own section, we just added it into this 6-column worksheet. And what we did was we extended, or we transferred, our assets, liabilities, and owner's equity over to our balance sheet, okay? Literally, it's a copy and paste. We're just extending those numbers over. And remember, these are our permanent accounts. So when you think of balance sheet, think of permanent accounts, okay? And what we did was we took our 400 and 500 numbered accounts, which are our revenue and our expenses, and we moved those over to our income statement, okay? And when you think of income, you got to think of revenue minus expenses. And all we did was we transferred these over to the income statement section, okay? So when you think of income statement, I want you to think of temporary accounts, or our revenue and our expenses, okay? In order to get our net income, we simply took our revenue and we subtracted our expense accounts, okay? Since we have more revenue than we do expenses, we have a net income. Remember, if it were the opposite, and if our expenses were greater than our revenue, we would have a net loss, and we would need to put that in our credit column. But let's be happy that we've got some income here. Remember, that net income gets transferred over to our owner's equity account, okay? And since we need to increase our owner's equity, we are placing it in the credit column of our balance sheet. Once we have our net income on our income statement and on our balance sheet, you'll notice that we balance out our two columns, our debit column and our credit column. So what I want you to do now is I want you to take the numbers that you have from your mini project.
Kate, now you understand, Kate?
Yes, thank you. It was easier than than I thought.
Okay.
Just copy it.
Just transfer all the income statement items in the middle and the balance sheet items at the end. Balance sheet items are from assets, liabilities, and owner's equity. Income statement items are revenue and expenses. Then you have to calculate your revenue of loss and you have to transfer to balance sheet. Hello? Hello? Now everybody understand about this, right? Now we can go back to the other exercise, 4-4, if you understand, and also after you finish, we can go back to 4-4, right?
Mm-hmm.
4-4, that one also adjusting entries. Anybody want to read it? 4-4. Kate, are you going to read it? Are you tired, Kate?
Oh, sure. Cloudy Security Service has prepared the following trial balance before preparing its year and adjusting entries. The balance you can see in the book.
Trial balance.
Trial balance.
Yeah.
The first, the 1-year insurance policy of 3,840 was paid on March the 1st, 2016.
Mm-hmm.
Okay, again, we are dividing 3,840 to 12, and we calculated from March to December, which is 10 months.
Yeah. Debit and a credit. Which one is debit? Which one is credit? Which account is debit?
Prepaid insurance, we credit.
Yeah. Insurance expenses debit.
Yes. The automobiles have an estimated useful life. Oh, sorry, the second one.
Yeah.
Physical count of supplies at December 31st, 2016 shows 570 of supplies offhand. It's pretty similar with the last one.
Yeah. It's similar, yeah. Supplies expense and supplies.
Yes, supplies, we have to credit supplies.
And the expense we are going to show as debit balance here.
Yes, supplies expense debit. Number 3, automobiles have an estimated useful life of 10 years. Automobile 62,000, which means 6,200 per year. We are debiting accumulated depreciation automobile for 6,200.
And expense is 6,200 debit, yeah.
The office furniture had an estimated useful life of 7 years. Furniture 16,000 divided by 7.
Yeah.
Then accumulated depreciation office furniture.
Mm-hmm. And amortization expense, yeah.
Just wait a second. Yes, we credit the office furniture by this sum and debit.
Not office furniture. Amortization expense, depreciation or amortization accumulated amortization and amortization expense. The fixed asset, you can't do anything with the fixed asset because the cost has to be in the system, right?
Right. Sorry, what account we have to credit? Where is it?
Accumulated amortization furniture. Accumulated depreciation office furniture, that one has to be credit. Any fixed asset, the cost you can't touch, but you have to have additional line. That one is accumulated depreciation of furniture or accumulated depreciation of automobile. Those accounts is going to be used for the depreciation.
Mm-hmm.
Accumulated depreciation. In the trial balance, you can see that accounts, right? Automobile, under automobile, there is accumulated depreciation automobile.
Mm-hmm.
Under furniture also, you have accumulated depreciation of office furniture. That accounts, you have to use it.
Okay, do we have to add another row for the debit side?
No, that is in the bottom. But you don't have this in this trial balance, but you have to show in the worksheet.
Oh, I see, I see.
Yeah, have to show in the worksheet. The new trial balance is going to have that account.
Okay. Number 5. Employee salaries total to 230 per day. At December 31, 3 days of salaries are unpaid.
Mm-hmm.
They will be paying it in January.
Yeah, we are going to pay it in January, but we have to show that expenses in December, right?
Right, which is salaries expense debit 690 and salaries payable.
Yeah.
Credit.
Yeah, credit. Yes.
690.
Yeah.
6. One of Claudia's customer paid for a 6 months contract at a rate of 600 per month in advance on October 2016. The contract began on November the 1st, and Claudia credited unearned revenue at the time.
Mm-hmm.
Okay. He paid in October.
Yeah.
And the contract started on November.
Mm-hmm.
So it was 2 months of.
They paid for 6 months, but they started. Yeah, only 2 months is going to be show in the revenue account.
Yes, we are crediting unearned revenue, and we are debiting. We're increasing revenue.
Increasing revenue, decreasing unearned.
Yes.
Increasing revenue by credit side, decreasing unearned revenue by debit side. 2 months. They finished, yeah. They finished the 2 months job, then that amount you have to show as revenue.
Yes. And 4 months is more.
The 4 months is going to be next year. That one is going to stay in the balance sheet.
Yes.
Yeah. Now we understand how to do this and how to do the worksheet also.
Yes, yes.
Now we can start 47, that one is closing entries.
Closing entries. Mm-hmm.
This is the cycle. After the adjustments, end of the year, now we are going to close the books. Close the books means all the temporary accounts, that means revenue and expenses we are going to close and calculate our total, calculate our profit or loss, transfer to capital. The next year we are going to have only balance sheet items as the beginning balance of next year. That's what we are going to do it now. Are you tired to read Kate again?
No, I'm not tired. I just trying to think in parallel. Closing entries. Accountants may perform the closing process annually. Closing entries are journal entries used to empty temporary accounts, revenue, expenses, and drawings accounts at the end of a reporting period and transfer their balances into a permanent account, capital. The use of closing entries resets the temporary accounts to begin accumulating new transactions in the next period. Otherwise, the balances in these accounts would be incorrectly included in the totals for the following reporting period. The goal is to make the posted balance of the retained earnings account match what we reported on the statement of returning earnings and start the next period with a zero balance for all temporary accounts.
You know what are the temporary accounts, right?
Yes.
Yeah. The temporary accounts are revenue and expenses because the reason is we have to have a new capital account for the next year.
Every year, yes.
Then close all the revenues and close all the expense accounts and transfer to new ledger that is only 1 year they are preparing income summary account. In the computer's accounting, there nothing happened. When you press the button, it's automatically transfer everything to capital and close all the accounts. But in the manual accounting, you have a separate accounts called income summary account, transfer everything to that, and then the capital, then the profit or loss transfer to capital. That is the way we are going to do it now.
Okay, permanent balance sheet accounts including assets, liabilities, and most equity accounts. These account balances roll over into the next period. So the ending balance of this period will be the beginning balance for the next period. Temporary. Revenues, expenses, dividends, or withdrawals account. These account balances do not roll over into the next period after closing. The closing process reduces revenue, expense, and dividends account balances, temporary accounts, to zero. So they are ready to receive data for the next accounting period. The basic sequence of closing entries is first, close revenue accounts. Debit all revenue accounts and credit the income summary account, thereby clearing out the balances in the revenue accounts. Second, close expense accounts. Credit all expense accounts and debit the income summary account, thereby clearing out the balances in all expense accounts. Third, close income summary account. Code the income summary account to the retained earnings account. If there was a profit in the period, then this entry is a debit to the income summary account and a credit to the retained earnings account. If there was a loss in the period, then this entry is a credit to the income summary account and a debit to the retained earnings account. Close withdrawals or dividends account. After we add net income or subtract net loss on the statement of retained earnings, what do we do next? We subtract any drawings or dividends to get the ending retained earnings. This will be the journal entry form of doing this calculation, but be careful because you do not want to use the amount of returned earnings, but dividends. We want to decrease drawings or retained earnings debit and remove the balance in drawings or dividends credit for the amount of the dividends. The net result of these activities is to move the net profit or loss for the period into the retained earning account, which appears in the stockholders' equity section of the balance sheet. Since the income summary account is only a transitional account, it's also acceptable to close directly to the return earning account and bypass the income summary account entirely. Then next comes an example.
Yeah, these are examples. You can see the examples. Step by step they are showing. The first step is their revenue. The revenue is normal side is credit. They are transferring to debit. When they are transferring to debit, the credit balance is going to income summary account, same as like this. This is the income summary account. And I'm going to show. Let me see. Points, capital. Okay. I don't have. Let me see. Okay. This is the first step. We are transferring to debit side and credit side income summary account. That one is, this is the income summary account. Let me see. Drawings. No, but I don't have that. Capital account. No, sorry. I think I deleted. I have that examples. Drawings. I'm sorry, I deleted that one. Because when we are transferring to credit side, then we have to put somewhere else in debit side, right? That is, we are using income summary account. That is the expenses. Yeah, income summary account. Income summary account is like an income statement. The income is going to be in the credit side, expenses is going to the debit side. That one is showing like this. I think when you started to do the journal, then you will understand more. Oh, I have here. Okay. This is the revenue account. Revenue normal side is debit side and credit side. When we are transferring to debit side, then the same amount we are transferring in income summary account in the credit side. It's different. Sorry, I have the example is different. Summary account. Okay. This is the example. This is the revenue we are transferring to income summary account. These are the expenses. When we are closing, we have to put in the debit side. And now debit and the credit is difference between debit and the credit is 0. This is already closed. When we are closing, we are transferring this amount to income summary account. That is the first step. The second step, all the expenses are in the debit side, normal side, right? Then we have to transfer to credit side. And when we are transferring to credit side, then those amounts are going to be in the debit side in the income summary account. That is the second step. In the income summary account, then we are calculating our difference between debit and the credit. The debit is higher, credit is higher, revenue is higher, expenses are less. Then our balance is going to be in the credit side, because the higher side, that one is the profit. Then the profit, this is the third step. The third step, we are transferring the profit to capital account. That is in the capital. Here, we are transferring the capital account as this is the ledger. It's going to be in the credit side. Then it's going to be total. It's going to be like this. Then after that, we are closing our drawing. Now, when you do the exercise, you will understand more. I'm doing so many and showing so many things. Okay, start from the exercise. Okay. Number one, this is your trial balance. In the trial balance, you can see income statement accounts. That is the first one is sales 480,000, right? Okay. Sales revenue. According to the trial balance, you can see how much is the sales revenue, right? Sales revenue is 480,000. With the sales revenue, there is another two accounts. One is sales returns and sales discount. Those also we have to go with the sales. We have to reverse that one also. You understand what I'm talking about? Sales is 80,000. When we close the sales, that one is going to be in the debit side, right? At the same time, we have to close returns and discount also because those two are related with that. 480 is not exactly sales because we have returns and allowances also, right? Then first we have to close those three accounts. When we closing, sales is in the credit side. That one is going to be in the debit side. That is the first line. Then our returns and discount, that one are in the debit side. That one is going to be in the credit side. That is, we are closing. The difference between those two, we are going to send it to income summary account. That is the third line. This one is going to be income summary account. This is the first step. When we are closing the revenue account, we are going to close those three. If it is in the debit side, credit side, we have to transfer to debit side to make zero. And sales returns and discount are in the debit side, we are transferring to credit side to make zero. The difference between those two, this is the actual sales because we have returns and discounts. The actual sales, we are transferring to income summary account. That is income summary account. This is the income summary account is transferring to this. We are going to write the first journal. That is the first journal. Now we close all the revenue account. Next step, the second step is close all the expense account. The expense account starting from cost of goods sold up to insurance expense. Those are the expense account. All the expense accounts are in the debit side. We are going to put everything in the credit side first. Because when we are closing, we are putting all in the debit side to make zero. The total is going to be in the income summary account in the debit side. Because we are closing all the expense account. If you have anything in the debit side, credit side, you have to have something in the debit side. That one is going to be the income summary account. Income summary account, now we have 433,000 in the debit. And here income summary account 459,000. Then that is the second step. After you finish, the expense account, now we are going to calculate our
Drawings.
income summary account, here profit, drawings fourth. This is our income summary account. This is we transfer to credit side, this one we transfer to debit side. The difference between those two is, see the ledger. After we transfer this is our profit, right? This is our profit. Now we are closing this one also. If you want to close, you have to put in the debit side. Then next entry is going to be in the capital account in the credit side. In that case, the profit we are transferring to debit side in the income summary account and credit side in the capital account. That is the third one. You understand, right? You can do like this way too, but see, this is your total. This minus this is your profit. The profit you are going to transfer to capital account. That capital account is going to be profit, always go to the credit side in the capital account. That one is going to be in the credit side. And income summary you are closing. In that case, that one is going to be in the debit side. That is the third step, closing the income summary account. Now you close revenue account, that is zero. It's not going to be rollover next year. Expense accounts also you close, that is zero balance. The third part you close the income summary account, that one also now zero balance. After you finish this, you are going to finish the drawings account, close the drawings account. Drawings account, according to your book, you have 10,000 and 8,000 for two people. In that case, this is the drawings. 18, total 18,000. When you are closing, you are going to put in the credit side, and then the second line is going to be in the capital account in the debit side, because this one is decreasing your capital. Drawings always decreasing your capital. When you are closing, this one is going to be in the credit side. That one is the fourth step. Then you are going to calculate your capital. How much is your capital now? This is your capital from your book. This is your profit. The balance is 116,000. Then when you put the record your drawings, now your balance is 116 minus 18. This is a new balance. This is the balance you are going to take to next year. Now you are going to prepare the post-closing trial balance. Post-closing trial balance, all the balance sheet items are going exactly the same amount. Only the capital is going to be new capital, because in your book you have capital 40,000 and 50,000, 90,000. But after your profit and drawings, your new balance is going to be 98,000. Then this is the last part. Prepare the closing entries, calculate the owner's equity. The third C is prepare the post-closing trial balance. That is this.
Okay, and all other accounts like bank, accounts receivable,
Yeah,
merchandise inventory, we just keep for next year.
yeah, those are the permanent account. It's going to roll over to next year. Yeah, because bank we can't close because we have a balance. It's going to be continue, right? The
Right.
same way all the balance sheet items they are going to same amount for the next year except capital. Capital is the updating with the profit or loss and the drawings. The other accounts are closed. Next year, you are going to start from zero balance, all the temporary accounts.
Mm-hmm.
Even in the computerized accounting, also you have to select only close the box. The system automatically close everything. The next year you will see fresh ledger. I hope you understand about adjusting entries and closing entries today. Thank you very much for your cooperation, and we can do the next exercise tomorrow. Continue next tomorrow, right?
Okay.
Thank
Okay.
you so much for your patience and listening, and we will see you tomorrow.
Thank you, Matilda. See you tomorrow. Hope
See
to oversleep with
Thank
it.
you.
That understanding will come after we will sleep with these thoughts.
you. Okay. I
Thank
think because you people are smart and also you have knowledge, it's easy to understand everything. For me, also very easy to teach you because you are going fast. The people, those who are coming, some people they are coming with a different knowledge without accounting knowledge. That people I have hard time with debit and a credit, understanding the debit and a credit. It takes time, but for you, you are doing fast. You people are accountants, right?
Matilda, may I ask you something about the topic?
Okay.
I have a part-time job in a very small organization. It's a startup. They initially asked me to check something not some financial information, but now they realize they just don't have any manual accounting yet because the startup is selling products, but all what the owner has just some pieces of paper with ununderstandable writings. So I was thinking if I can download QuickBooks for them.
Yeah. It's very good. QuickBook is very good. First, sort all the documents and put everything in Excel, and that's easier for you to start QuickBook because they have a history, right?
Yes.
History means they have sales and they have purchase, they have bank transaction. Those things you have to put in Excel and see. Or otherwise, you can start from the beginning too. Download the QuickBook and sort all the documents. Start from the beginning. I will help you when you download. If you want, I'm going to send the link for you.
Yes, I want. I've heard that there is a first month free period for QuickBooks.
Yeah, there's a trial also. I have a link for the students. Then you can try that one, and then you can transfer to whenever they purchase QuickBooks, the commercial. Then you can transfer that one too. I will.
Thank you. I will appreciate the link. What if they decide not to buy QuickBooks? Can we somehow download data that I will upload? For example, if they will decide to hire a professional accountant,
You are a professional accountant.
Well, I am, but I have never had this experience. So I'm trying right now, but finally, in the end of the year, they might have another person. How can I transfer the data? Can I save it?
You can export to Excel and transfer the data.
Okay, that's great.
I will show you everything. First, enter all the data, and then trial balance, income statement, balance sheet, everything from the screen. You can export to Excel and send it to them.
Okay, that's great.
Yeah, I will show that one. And I'm going to send the link today. Try that link, and you can start doing that, and then you can finish everything and send it to them. They already had the business last year.
No, this is the first fiscal year. They start on June.
Oh, June, 6 months, right?
Yes.
Yeah. Then you have to record all the 6 months information, right?
Yes, I have.
Sort it out. First sort all the documents, then start doing that. Yeah.
Okay. Oh, thank you.
You're welcome. I'm going to send the link for everybody to download for the QuickBook course. I'm going to send it to you today for that. Yeah.
Okay.
Okay.
Thanks
Thanks so much.
Bye. See you tomorrow.